Welcome to the Daily Update. This is being prepared Friday, April 29th, where we'll look at the action in the market today and then see how things look for Monday, May 2nd. It was a pretty negative day, and there's not an awful lot of positive things to say other than we are short-term oversold. In some ways, we're intermediate-term oversold. So we saw a really big down move. And if we see some kind of a bounce, it may be more in reaction to going down too far too fast. So let's go back and talk about what happened. Right at the open, we did have a gap lower, and we gapped below the daily pivot, which was at about 42.62. And remember, I round these numbers, either up or down, so they're not going to be exact when I talk about pivot and support levels and resistance levels. The daily pivot then acted as resistance. We tried to get back up above that, but it just didn't happen. As the day went on, selling went down to S1, which was at 42.15. Any kind of a rebound that we tried failed. Going into the close, we saw selling go down to S2, which was at 41.42. We closed just below S2 and just off of the low. So we ended up being down 3.63%. Volume was above average. And of course, the technicals are pretty much negative, but a little extreme negative in a lot of instances. We're still worried about inflation and interest rates, the geopolitical concerns, earnings. That's kind of what drove things on Friday. Amazon came out with earnings that weren't well received. Apple, even though they had a good earnings report, they made some supply chain comments that kind of freaked out the markets as far as inflation and supply chain issues. We saw some economic reports that came out that are showing some inflation, and the market just decided to keep going. And so we kind of have to treat Thursday as a dead cat bounce. Yeah, it was a nice move up, but we worked off that short-term oversold condition and then came right back down and then have now continued lower. So what are some comments that we can make? It was a broad-based decline. Every one of the sectors in the S&P ended up negative. Amazon, the earnings were disappointing. And inflation and supply chain fears, that's mainly what Apple was talking about. And just this whole backdrop that has been going on for quite a while now. Interest rates did advance and stocks declined. So we're back to seeing, at least on Friday, more of what we have been seeing, where previously in the week, we saw interest rates going up and stocks going up. Interest rates going down, stocks going down. Well, it's switched back more to what we're used to lately. We are short-term oversold, and on some cases, you could even say intermediate term. The equity put-call ratio is still quite high. A lot of people are buying puts, and that's really spiking up. The technicals, yeah, they are negative. And we lost that intermediate term support level at 42.76 that we had regained back on Thursday. The S&P is in correction territory, and the 10 to the 5 yield curve is still inverted. Now, as I've stated in other videos, some people might go, well, 10 to 5, that's not a useful yield curve. I'm not going to regard that. That's fine. All of the other yield curves that we follow have gone back to looking more normal. This one just remains inverted. So I'm kind of holding out for that one personally. But you may come to a different conclusion. The economic reports that came out showed that personal income decreased while spending increased. Oh, imagine that. And this suggests that a lot of people are living off of their savings right now or going into debt just to make ends meet. And that is not a good situation. Employment costs increased, so that's biting into company profits. And the PCE Price Index, that increased, which is showing some inflation issues. Consumer sentiment increased. We had the final report from the University of Michigan, consumer sentiment. It didn't change very much, and it's still pretty negative, but people are looking out into the future and hoping that things will get better. Maybe not right now, but somewhere down the line. And then the Chicago Purchasing Managers Index decreased. The trend condition is we are negative. The bias is negative because we had a strong down day, and the momentum is negative. So let's go back and look at the day's session. First, let's look at sentiment. We're getting quite fearful now. Currently, we are at 27, and here is the historical chart right here to show where we're at. The further down we can go, the more extreme we get until we get below 25. Really, when we get below 20, that's when we're looking for more of an extreme negative reading and more of a critical mass freak out all at the same time. It could happen from anywhere we're at right now, but what we saw back in March was a real decline and then a bounce up out of that. The VIX really continues to spike up on a closing basis. It's right back where it was on Wednesday. We increased on Wednesday, came down on Thursday, and then went back up on Friday. The bar chart is also showing a bit of a spike, and we closed right about at the top with this. And then we're getting back into an extreme reading based on the RSI 9 period, where we're seeing the VIX really spike up, and maybe we've gone up a little too far, too fast. That's not to say that we can't go higher. You can see where we've had higher readings in the RSI in the past. The equity put call ratio that I mentioned, it's still very high. It's lower than it was, but this is still pretty extreme compared to where it has been over the last year or so. And this is a 5-period moving average of the 1-day put call ratio. And it shows how we topped out. We curled over a little bit after Thursday. Well, we're just kind of coming down a little bit less right now after Friday. The Ulcer Index continues to climb. That's just showing an increase in fear in the market. And here's the final release of the consumer sentiment, where we're seeing the 2-year yield really start to go up. And this is consumer sentiment, which had been lower than this. People are feeling a little bit better because they have a hopeful future. They hope that gas prices will come down. They hope that inflation may get under control. Doesn't mean those things will happen. It's just people are looking out further and trying to find some hope. And as I point out when we show this chart, in a good, healthy economic environment, it's okay to see interest rates going up, but you want to see consumer sentiment going up at the same time. Right now, they're pretty much going in an opposite direction. As far as the sectors, every one of them was down. The one that got hit the least was materials, and they were down 2.01%. The one that got hit the most was discretionary, and it was down over 5%. Here is how the sectors have performed since the all-time high. Energy, utilities, staples, doing pretty good. Way over not doing so good, communication, discretionary, tech. And financials are starting to show a little bit more weakness right now as well. Looking intraday, we gapped lower right at the open below the pivot. We tried to get back up above the pivot, but it acted as resistance. That was rejected. We went all the way down to S1. We tried a little bit to bounce here. No, that wasn't happening. We broke down through S1. Trailed down a little bit, and then as the day went on, we went all the way down to S2. We broke below S2 and then closed just off of the lows for the day. So it was a broad-based sell-off. Here's how it looks on the daily chart, where we had regained this intermediate term support before. Well, we fell back below that, and now we're going back to the low that was set back in February. We're getting right near that level. And this dashed line here is a previous pivot level that may be acting as some kind of support. If not, we might end up dropping down to this long-term support. As far as the technical alerts, mostly were negative. On Thursday, we saw a lot of bright, cheery green or blue ones here. On Friday, a lot of negative ones. Let me focus on the S&P. We dropped below 4,200 and just a mess across the board. Gold was able to get back above 1,900. But just, you're seeing a lot of across all the different sectors, a lot of really negative signals right now. As far as Fed Watch, we're not really changing all that much from day to day, but we do want to keep an eye on this. At the meeting on May 4th, which is coming up this coming week, there is a 97.1% chance that we will be at 0.75% to 1% after that meeting. Here is the historical chart. Feel free to pause the video to look at this if you would like. Looking out into the June 15th meeting, there's an 88.8% chance that we'll be at 1.5 to 1.75 after that meeting. Here's the historical chart. Then at the July 27th meeting, there's an 82.7% chance that we'll be at 2 to 2.25 after that meeting. And here's the historical chart. That's as far out as I'm going right now because the next meeting after this is September, and nobody really knows. Nobody really knows even for July, but at least this is kind of feeding into the scenario that's going with the market right now. Now, this is where I'm going to get a little bit different, and I will see how this goes. So again, feedback if you like this, if you don't like this. I'm just trying to take a different approach with these things right now. So what we're looking at first here are those things that are outperforming. But what's doing good in the markets right now? So this is what I call a technical overview. Those that are showing some strength or they're outperforming when on a relative basis. And I'm just going to list them here. We're not going to look at the charts. I'm just going to give you a list. Value is doing better than growth. Growth is doing better than bonds. And growth is really struggling too. That must mean bonds are really doing bad, and they are on a price basis. The 10-year interest rate is outperforming tech and the S&P. The low volatility stocks, they're doing better. They're holding up a little better. They were down on Friday, but not down as much as everything else. Energy has been doing really well. It's been outperforming. Energy is also doing a lot better than tech. And the CRB, this is where we measure inflation. It's doing better than the S&P right now. Commodities, the things that we have to buy to produce things, they then are bought by companies. They make their products, then they send them to the stores and we buy them. If we see an increase in these prices, we see an increase ultimately when we go to purchase things. Gold is still outperforming the S&P. Staples, the things you have to have, are outperforming discretionary. The things you don't necessarily have to have are more the luxury items. Junk bonds, because they're giving you a better yield, they're outperforming treasury bonds. And even junk bonds are having some trouble right now. And again, that just shows, because this is based on price, and this just shows how weak bonds have been. Now, some of the positive things that we can look at, energy is positive. The CRB, meaning commodities, are positive. Gold is still positive. Interest rates, there are ETFs you can get into that bank on interest rates. Staples, those are the ones that are doing positive. Now, what about those that are underperforming? And this is a pretty long list. The NASDAQ 100, a lot of tech stocks, a lot of growth stocks. It's underperforming the S&P, where the S&P is underperforming interest rates. Growth is underperforming value, where the tech or growth sector, that's another big part of the growth sector, is outperforming or underperforming interest rates and the S&P. And I also have the SPX and the SPY. If you look at the ETF of the S&P 500, the S&P is underperforming the CRB index. The S&P 100, the biggest stocks in the S&P 500, they're underperforming the rest of the S&P 500. Discretionary is underperforming staples. What are some market negatives? And this is a pretty long list. Just wait, we've got an even longer list after this. The Dow Jones Composite, where you take the Dow, the trannies, and the utilities, cram them together into one index, that is negative. Discretionary is underperforming staples. The long-term trend is still declining. We're underneath the 200-day simple moving average. There are no changes right now in the chart variations because they're all negative right now. This is the Renko, the Kegi, the three-line break. And the world indexes, they continue to decline. So not only in the U.S. are we having trouble, but we're having trouble globally. Junk bonds are outperforming treasury bonds, but junk bonds are negative. There we go. The FANG index is negative. Small caps, the Dow, mid caps, NASDAQ, any stock index you want to look at right now is negative. The NASDAQ 100, the NYSE Composite, the all stocks, that's including U.S. and world stocks. ARC Innovation. Bitcoin's even getting spanked a little bit these days. It hasn't really moved all that much lately. The Wilshire, and then the different world indexes that we look at, and the corporate bonds. Those are also negative. Let's look at some of the technical overview for the negative indicators. And this is a long list right here. But we're below, and this is where we're just looking at the S&P 500 with this. We're below all the moving averages. The moving averages themselves are declining. The advanced decline line is negative. Momentum indicators are negative. The parabolic SAR is negative. The new highs and new lows, we're seeing a real expansion of new lows, and that is declining. The BPI, the bullish percent index, is declining. The commodity channel index, both based on 14 and 20 periods, is negative. The Chaikin oscillator is negative. The Chaikin money flow is negative. The force index is negative. The money flow index, special K, that's longer term for judging how the trend is going. That is negative. The Stoke RSI, that's shorter term and looking a little oversold, at least on a short-term basis. And the ultimate oscillator is negative. Vortex, Williams percent R, summation index, accumulation distribution. Is this ever going to stop? The boom indicator, we're getting pretty far away of the 50-period moving average. We still have a ways to go to get to the 200. The percent B, that's the Bollinger Band measurement. It's not extreme, but it is negative. And the RSI, based on 9 and 14 periods. So that's a whole list of some real negative indicators that we have. Let's look at Brett. This is just one day. This is the advanced decline ratio. And we're showing an extreme negative reading. We really popped up after Thursday. Well, we're looking kind of bipolar here, where we went extreme negative after Friday. Now, another thing that I ran across, it's a website called FactSet, and they come out with earnings information. And this is just a screenshot where it says overall 55%, so over half of the S&P 500 companies have reported their results right as of Friday. Of these companies, 80% of those have reported actual earnings per share above estimates, which is above the 5-year average of 77%. Okay? In aggregate, or taken together, companies are reporting earnings that are 3.4% above estimates, which is below the 5-year average of 8.9%. So you can see this as half empty, half full. They're doing better than expected, but maybe not as good historically. And here's just a chart. I'm not going to read through this whole thing. If you want to pause this is freely available. Just type in S&P 500 earnings FactSet, and you should be able to get to this. But this just breaks down all the different sectors just to say, were we below estimates? Were we in line with what was expected? Or were we above? And then it just shows you how these different companies performed with their earnings. Then looking at our trend, we are negative. With the big down day that we saw on Friday, the ADX is continuing to advance, and the red line turned up, the green line is turning down. The Arun is going back up to saying sellers are in full control, buying power is dropping off, the oscillator is going down. Looking at the S&P, this is another thing. We went down pretty far, pretty fast. This thing's been just all over the place. It's like a defibrillator. We went extreme negative, then we went extreme positive. Now we're back to way, way extreme negative. Then looking at the rate of change going out 10 periods, extreme negative. 20 periods, back to extreme negative. 200 periods, we dropped below 200, or dropped below zero on the 200. And even in the 250, we are negative. Not very nice, but we are negative right now. We haven't been negative since the COVID plunge. Standard deviation, we are getting far away from the median or the standard price of the S&P 500. So that's starting to spike up. And we usually look for things to fall back toward the standard deviation price. Here's the stochastic, short-term, extreme. Intermediate term, extreme. Long-term, getting extreme and still declining. Fibonacci, we had regained the 50% after Thursday, only to lose that, and now we're down below the 61.8% retracement after Friday. Different trading systems. Elder, negative, based on the S&P. Based on the SPY, negative. Based on the diamonds, negative. Qs, negative. So you can see how things are not very positive right now. Here's the one yield curve that is still inverted, the 10 to the 5. It is minus 0.03 right now. All the other yield curves are doing okay. Broad market, the dollar, after it had just been screaming up, saw a bit of a pullback. This is the daily chart, and here is the weekly chart. So overall, it still did well, but it did close below 103, where we had been above that after Thursday. This is the other thing we're keeping an eye on. We're watching the Japanese yen, which has been declining, the euro declining, the dollar advancing, because there's potentially some negative things that are developing, and I'm trying to do some more research on that. Oil was at 104.69. It declined a little bit on Friday. Then here's some of the Isabel Net blog charts that you might find interesting. This is Goldman Sachs, and this is their prediction for the 10-year yield. And these red lines are just suggesting what they think is going to happen. And we stay anywhere between 2.5% to 3% this whole time. Take that for what it's worth. There's another chart. The part that applies to us right now is this second area. These are midterm years that see the largest intraday year pullback. That's when we see a real downturn. Midterm, meaning the elections. The blue part is the S&P average of the intraday or intra-year pullback. And we usually have a decline of 17.1%. Then, this is the part that's interesting, is the S&P 500 average return after a year. So looking out a year from now, after we hit those lows, it's the averages, it's up 32% from there. Now, there are some videos that I watch and even some channels that I recommended to you where they do this. They take some statistical view like this, and then they say, okay, let's look out 6 months, 1 year, 2 years, 5 years, 10 years from now, and they come up with all this analysis. I'm not a big believer in that because I'm not a portfolio manager, and I like to go with the trend when it's going up, go with the trend when it's going down, and do sideways strategies when we're bouncing all around. Money managers don't have that luxury that an individual investor does. So this is interesting, and I pay attention to this, but I don't necessarily apply it to my own analysis. Then this is just showing Federal Reserve Bank of Cleveland, and they're predicting what is the likelihood of a recession, using the yield curve to justify that, where they're seeing not it being very probable right now. And this red area is the projection. That's a guess. All right, so what's our outlook then for Monday? The technicals are negative. The markets are still in this intermediate term range. We're getting right down to the bottom. We're testing the previous low. Are we going to hold that, or are we going to keep going lower? We have the growth versus value battle. The economic reports coming out. We have ISM manufacturing. That's a pretty significant one. And then construction spending is coming out. The different geopolitical events. Russia, Ukraine could explode or get better at any time. China with the supply chain issues, and Apple cited that as a problem. Inflation and interest rates. Oil. Earnings that are coming out. Different people from the Fed giving speeches or doing interviews. And then this Japan potential problem that could be developing. So what are our scenarios? We are in a downtrend right now. The ADX is positive and going up. So this is the working scenario. What will keep us going down is rising interest rates and inflation fears. I've gone back to that because we switched back to that on Friday. Earnings could also send the markets lower, just like they did on Friday. Fed speak, anything like that. But the market just decided that it wanted to go down. The technicals are negative, but we are oversold, especially in the short term. The up possibility, short and even some intermediate term, we are oversold. here are the positive scenarios that still are not necessarily on the table, where we're seeing some longer-term bottom signals that could be generating some positive signals. Those haven't happened yet, and I showed a little bit of those in yesterday's video. The positive backdrop after the yield curve inverts, well, we're not, or reinverts. We are still inverted according to my calculations, but you may disagree with that. The Staples ratio spike, and we're still spiking up. So we don't know if we've hit a top in that. The 2-year yield spike, we're still going up there too. So we don't know if that's topped out. Small cap thrust prior to the S&P 500, that hasn't happened yet. And then the technicals are that we just get so far oversold because the moving averages are way above where we're at. The pivots may provide some kind of support. And if we do get some kind of a bounce, we might quickly hit resistance. Then sideways, this is if the ADX drops back below 20, which is not where we're at right now. And it's a negative trend. So our conclusion then is the S&P is negative. Short term, negative, oversold. Intermediate term, negative, and you could make a case for being oversold. The oscillators are negative and we're below a lot of important moving averages. Long term, we're below the 200-day simple moving average. So thank you. Have a very, very good weekend. I will prepare the weekly video over the weekend. I'm also trying some new ideas with that. And so please let me know what you like, what you don't like, what's good, what's bad, what I should change, and so forth.